listeners. I am Manushree Saggar, Vice President at ICRA Limited, and through this podcast, I will be sharing our views on the performance of the affordable housing finance companies and the outlook for FY23. As per our estimates, the total loan book of AHFCs stood at about Rs 74,500 crores as on June 30, 2022, registering a robust year-on-year growth of 21%, supported by the improvement in the operating environment and good demand. The disbursement levels of AHFCs reached an all-time high in Q4 FY22. However, the share of AHFCs remains small in the overall housing finance industry at about 6%. Nevertheless, the underpenetrated market and government focus on housing for all are likely to support growth going forward as well. In terms of portfolio mix, almost 75% of the portfolio consists of housing loans. The reported asset quality indicators, which had peaked in Q3 FY22 mainly because the entities aligned their reporting with the clarification issued by the RBI on IRA norms, improved in Q4 FY22 and Q1 FY23 with improved collection efficiency. While the headline NPA or Stage 3 numbers could remain elevated, as it would be difficult for the borrowers to clear their entire overdues in one shot, and hence come out of the NPA tagging. However, the overall 90 plus DPD is expected to remain range bound. Further, the restructured book for these AHFCs stood at about 6% of the loan book as on March end, and the performance of this book will remain a monitorable. The AHFCs continue to operate at relatively lower leverage, supported by regular capital raising, as internal capital generation has been lower than portfolio growth. Also, given the relatively lower risk weights on low ticket housing loans, the reported capital adequacy for these entities remain well above regulatory guidelines. With NHB providing liquidity support to HFCs during the COVID-19 pandemic, the share of NHB funding in the overall mix has increased, though banks continue to have a dominant share. The presence of capital market funding has remained largely stable, with only a few higher rated entities tapping the capital markets. Bank borrowing and NHB funding are likely to dominate the funding mix going forward as well. On the profitability front, while the net interest margins for AHFCs improved in FY22, supported by the decline in the overall cost of funds, the impact was partly offset by the increase in operating expenses. However, with the moderation in credit cost and some upfront income from direct assignment transactions, the overall return indicators improved in FY22 and the AHFCs reported a return on managed assets of 2.6%. ICRA expects profitability to remain similar in FY23. Thank you for listening and stay tuned for our upcoming podcasts.